So obviously you're an expert technician and you've taught this to top institutions, to billionaires, to some of the best individual traders in the world. You run in that circle. What happens with you personally, but also that group of exactly that, the discipline aspect of trading? I've said this in previous interviews, but it's one of my favorite things it seems like a lot of trading is 70% discipline, 20% skill, and 10% luck. So that discipline thing, obviously now that you've done this for decades, is there something you do? Is there a trick of the trade to keep the train on the tracks in terms of discipline? When you have your entry rules, ABC, your exit rules, XYZ, we all get that little fear or that greed. Do you have a piece of advice for that? Because I feel like, honestly, after you learn some of the rules of trading, the hardest part truly is discipline.
Yeah. Well, actually, there are quite a few things you can do. And the good thing is, yes, it can be taught and it can be achieved. And I think it's relatively easy. Well, the first thing you have to have in order to have discipline is to eliminate doubts. Because if you start second guessing yourself, then you will be more disciplined. In order to start second guessing yourself, you must have a trading plan. If you're not driven, if you're not rules based, if you're not model driven, then you will start hesitating and getting in and out with every news item that is available in the market. So the first thing is to have a plan. That sets up the base, if you will, for discipline, because you say, all right, let give me a very simple example. If the market is above, let's say, the 200-day moving average and the market DV is below threshold level, that I will get in. That in and of itself gives you the background of discipline, because you won't be saying, should I enter here or should I enter there? You won't go from forecasting, you go to if-then analysis. If this happens, then I will enter. Now, once you have that, then there are the second thing you can do is have small position sizing. If you don't have a lot of money in stake in the market, that will decrease immediately your emotional association with this particular trade. Imagine, let me give you a very hypothetical example. If you had a trade, the exact same trade, and on one side you were risking $1, and in the other you were risking $1 million, and I ask you to manage the exact same position, which one would you be more prone to be less disciplined with?
I mean, the $1 million one, my emotions would be all over the map, because like the slightest move would either make me euphoric or depressed.
Exactly. So the second thing is, first of all, is have a rule set. The second is to try to decrease your emotional involvement with your position, so have a small position size. And the third thing one can do to have more discipline is what I call RBT, repetition-based discipline, RBD, which means if you do it over and over and over again, then after a little while, you won't think of it too much. Now, of course, the way to do it, to practice, is on a demo account. And I know most people frown upon it and say, okay, I mean, it's not a real thing. And my reply to that would be, you get 80% of the experience with 0% of the risk. So the more people practice using a trading plan and small position sizing, after a little while, you desensitize your reaction to the markets. To give it via another example, imagine watching a thriller, and the leading person comes in with a knife, stabs someone. Obviously, the first time you see it, you get scared. Now, imagine if you see the same thing 30 times more. After a little while, you know what happens, so it doesn't really scare you. So I think by following these three steps, people can gradually build discipline.
I would implore anyone listening to this for a more in-depth conversation to probably look up things such as Kelly criterion, and that's just like betting of how much you should risk, shouldn't risk, and that's what Alex is referring to here with the R value. On that note, for your account, what is your unit of risk? Is it 1%, 2, 5, 25, 50? What do you find is mathematically appropriate to risk per trade?
That's a good question. Well, I think position sizing is you can see it from 2 points. One is the purely mathematical point. The second is the emotional point. So I try to approach it from the emotional point of view, in the sense that, are you trying to maximize risk because you have different position sizing algorithms for that, or are you trying to maximize your returns or trying to minimize your risk? As far as I'm concerned, I'm always trying to minimize my risk. So from a mathematical point of view, I may not be taking the optimal position sizing, but that's the right answer, the perfect answer for me. But for someone else, there may be a different perfect answer because they may be actually trying to maximize the reward. So the mathematics of position sizing, which of course the definitive book and work on that is by Ralph Vince, great guy, really, really great guy, will lead you to different numbers depending on your profile.
Is it not maybe for you individually, but maybe from what you've seen in the industry? A lot of what I've consumed is basically saying never risk more than 2% of your portfolio. Do you find that to be somewhat true in that realm? And I'm not saying exactly, is that how, let's call it, the big players actually think of things, or are they going even smaller, even bigger? What do you think the normal is?
Again, I think it would depend on the risk preferences. My answer would be different depending on the person asking me. So if someone who is completely new to this and wanted to learn, I would say that's probably a bit too much. But if someone who is a professional, and there are different ways to hedge your risk, for example, taking a large equity position, you can always use options to hedge it. I mean, so 2% might be, you can minimize that risk even if you had a larger position than 2%. But if we assume that the question is asked by a retail trader who's just trying to get some skin in the game, trying to learn, I would say probably stick to 1%, because even for a retail investor, depending where they are on the learning journey or the learning path, probably position sizing would be different. So it's better to start on the conservative side and start increasing it, because when you start to learn, your position sizing should be very small, because you don't want to get discouraged. What you actually want to do is get the repetition, and you try to do it as safely, because it doesn't affect your confidence. So have position sizing in a very safe environment. As you start building some kind of consistency, then you can flirt toward higher risk numbers, which again, your risk tolerance has to be, it's a function of your character and also your age. For myself, I'm almost 50 years old now, so I have some years to risk capital. But if I was probably in my 60s or 70s, then it would make sense for me to be risking too much on each particular trade.
And just to get ahead of any confusion, I just want the listeners to know that when we're talking about that risk value, it's commonly relative to your account, not the trade. It's not like if you buy a stock and it goes down 1%, it's not like we're necessarily campaigning. Correct. It might be appropriate to get out, but that's not what we're campaigning for.
Absolutely.
We're talking about the whole account.